I'm 73 years old. I have not written a check to the IRS in over 15 years, and everything I do is 100% legal. The IRS knows about it. My accountant knows about it. And after this video, you're going to know about it too. My name is Benjamin. I'm an Orthodox Jewish man. I own rental properties, and I'm about to show you the biggest difference between people who build wealth and people who stay broke. It's not how much money you make, it's how much money you keep. And the tax code is designed to help real estate owners keep almost all of it. If this is your first time here, please hit the subscribe button. Leave me a like. Leave me a comment. I want to hear from you. Let's get into it. Here's what most people do. They go to work. They earn $100,000. The government takes $30,000, $35,000, $40,000 of that before they even see it. Federal tax, state tax, Social Security, Medicare. By the time they get their check, they've already lost a third of their income. That's the W-2 world. That's how most Americans live, working hard and handing a chunk of every dollar over to Uncle Sam. Now, here is what real estate investors do. And this is what my father taught me, and his father taught him. We make the same $100,000, but instead of paying taxes on it, we use something called depreciation to wipe that income off our tax return. On paper, it looks like we made nothing. In reality, we made everything. And the IRS is perfectly fine with it because they wrote the rules this way on purpose. Let me explain how this works because it's simpler than people think. When you buy a rental property, the IRS says that building is wearing out over time. They call it depreciation. For a residential rental property, they spread that wear and tear over 27.5 years. So if you buy a property worth $500,000 and the building portion is worth $400,000, you get to deduct roughly $14,500 every single year. That's a paper loss. The building isn't actually falling apart. In most cases, it's going up in value. But the IRS lets you pretend it's losing value, and that paper loss offsets your rental income. Now here's where it gets really powerful. There's something called a cost segregation study. Instead of depreciating the whole building over 27 years, a specialist comes in and breaks it down into pieces. The appliances, the flooring, the landscaping, the parking lot, the cabinetry, the plumbing fixtures. Each of those pieces gets depreciated over 5, 7, or 15 years instead of 27. And as of 2025, the government permanently restored 100% bonus depreciation. That means you can write off all of those shorter life components in year 1, not spread over time, all at once, in the first year. Let me give you real numbers so you understand. You buy $1 million rental property. A cost segregation study identifies $300,000 in components that qualify for bonus depreciation. Year 1, you write off $300,000, plus your normal depreciation on the rest. You could be looking at $325,000 or more in deductions in a single year. If your total income is $300,000 from all sources, you just wiped out your entire tax bill. Legally. The IRS built this into the tax code because they want people to invest in housing. They want people to build and maintain rental properties. So they reward you for doing it. But wait, there's a catch, and I want to be honest with you about it. For most people, rental property losses are considered passive. That means they can only offset other passive income. They can't offset your salary from your job, unless you qualify for one of two things. Number 1, real estate professional status. If you spend 750 hours or more per year in real estate activities, and it's more than half your total working time, the IRS treats your rental losses as non-passive. That means those depreciation deductions can offset your W-2 income, your salary, your bonus, everything. This is how many Jewish families structure things. One spouse manages the properties full-time and qualifies as a real estate professional. Now all the depreciation from the entire portfolio can offset the other spouse's income. Number 2, the short-term rental loophole. If you rent a property for an average stay of 7 days or less, and you materially participate in managing it, the IRS classifies it as a non-passive activity. Same result. Your losses offset your active income. This is why you see so many smart investors buying vacation rentals and Airbnbs. It's not just about the nightly rate. It's about the tax strategy behind it. Now let me take this one step further. Because what I just told you is level 1. Level 2 is where generational wealth gets built. You've held your properties for years. They've appreciated. You want to move into something bigger. If you sell, you owe capital gains tax plus depreciation recapture. That could be hundreds of thousands of dollars to the IRS. Instead, you do a 1031 exchange. You sell one property and buy another of equal or greater value within 180 days. The capital gains tax is deferred. You pay nothing. Then, on the new property, you do another cost segregation study and start the depreciation cycle all over again. More deductions, more write-offs, more tax-free growth. And here's the part that makes my accountant smile. You keep doing 1031 exchanges your entire life. You never pay the capital gains. When you pass those properties to your children or your grandchildren, they receive what's called a stepped-up basis. That means the property's value resets to the current market price. All the capital gains you deferred over your entire lifetime? Erased. Your heirs inherit the properties and owe zero capital gains tax. Let me say that again because people miss this. You buy property, you depreciate it and pay no income tax. It goes up in value. You 1031 exchange into bigger property and pay no capital gains tax. You depreciate the new property and pay no income tax again. You repeat this for 30, 40, 50 years. You pass it to your children. They pay no tax either. That is the game. That is how wealth gets built and protected across generations. In Judaism, we have a concept called hishtadlut. It means personal effort. God provides the blessing, but you have to do your part. You have to put in the work. Learning the tax code is hishtadlut. Setting up the right structures is hishtadlut. Working with a good CPA who understands real estate is hishtadlut. God gave us a tax code that rewards ownership and building. It's on you to use it. The Torah says, "Remember the Lord your God, for it is He who gives you the power to acquire wealth." The power is there. The tools are there. The tax code is sitting right in front of you. But most people never pick it up. They just keep paying and complaining. Now, let me be very clear about something, because I don't want any misunderstandings. I am not telling you to cheat on your taxes. I am not telling you to do anything illegal. I'm telling you to use the tax code the way it was designed to be used. Every strategy I mentioned, depreciation, cost segregation, 1031 exchanges, real estate professional status, these are all written into the Internal Revenue Code. The IRS put them there. Congress approved them. They want you to use them. The only question is whether you will. I'm 73 years old. I've been doing this for 5 decades. I could have retired a long time ago, but I keep going because every property I buy is another deduction, another tax shelter, another asset that grows in value while the IRS lets me pretend it's shrinking. And one day my children and their children will inherit everything I built, and they won't owe a penny in taxes on it. That is the cheat code. It's not hidden, it's not a secret. It's just that most people are too busy working for a paycheck to learn how to keep one. Hit that subscribe button, leave me a like, and leave me a comment. Tell me, are you using depreciation on your properties, or are you still giving your money to the government? I want to hear from you. God bless you. Now go buy something and write it off.